Funding tip of the week. My name is Leo Cannell, the business financeologist, and we've been successful in helping our clients secure over $130 million in funding because of how we educate them on the funding process. Today's topic I think you're going to find very interesting. It's one that there's a lot of mythology, there's a lot of different beliefs and misunderstandings about credit inquiries. And so I want to ask the question, will credit inquiries ruin your credit? Will it ruin your life? It's a really important question. And I want to kind of talk about a little bit of the backdrop of it. So in the United States today, there's this perception that if you get a lot of credit inquiries on your credit, it's going to drop your credit score 100 points and really ruin any chance you have of securing funding. And I think a lot of that mythology is perpetuated by people in our business who are loan officers. And if you put yourself in the loan officer's place, what you don't want is you don't want someone going elsewhere and getting different rate quotes and not going with your financing options. So I think that's kind of part of it. But we're going to delve into the ins and outs of credit inquiries and how they work. There are basically two types of credit inquiries, okay? We've got soft inquiries and we've got hard inquiries. The soft inquiry is one that does not have an adverse effect on your credit report or your credit score. And so there are some lenders that we work with that will maybe do a 5, 7, 3-year term loan that will be a soft inquiry. Even though they're going to be loaning and lending you money, it's a soft inquiry. A soft inquiry does not have an adverse effect on your credit. A hard inquiry, on the other hand, may have an adverse effect, but it's very minimal typically. But a hard inquiry is one that you're going to get when you go and you're looking for a mortgage, you're looking for a car loan, maybe you're looking for a student loan, a credit card, a business loan. These are going to be hard inquiries that the lenders will pull, and some lenders will do a tri-merge pull, like a mortgage and auto loan oftentimes will, and they'll pull from Experian, TransUnion, and Equifax, tri-merge report, if you will. And some lenders will just pull one bureau. Maybe they'll just pull TransUnion, or maybe they'll just pull Equifax or Experian, and they'll just do that single bureau pull, which obviously has less of an effect on your credit. So let's break down how credit scores really work, because again, there's a lot of misinformation and mythology about credit score reporting and credit inquiries. So the first breakdown of your credit score, and we're talking about your credit score with the three big ones, right? Experian, Equifax, and TransUnion, is based 35% on payment history. So obviously that means you're avoiding 30-day and 60-day and 90-day late, and the bigger and more far behind you fall on your payments, whether it's a mortgage, car loan, etc., the more adverse effect on your credit. So if you have a 30-day late, it might drop your score a little bit. You have a 60-day, it's going to drop it a lot more, and a 90-day will drop it even more than that. And it will also be affected on how large the account is. So if you have a mortgage and you get a 60-day late on a mortgage report versus a $500 credit card, obviously the mortgage is going to have a bigger impact on your score. So payment history is first. The next part of your credit report and credit score is based 30% on outstanding debt, and really it's credit utilization. So it's, how much debt do you have, how many mortgages, how many car loans, how many student loans, and how you utilize that debt. If you have a bunch of credit cards that are maxed out, that high credit utilization is going to weigh down on your credit score. If you have credit card limits that are not maxed out, then that's going to be more advantageous. And so it's actually not good to not have any credit cards. Some people have this thought, oh, credit cards are bad, I don't want to have any credit cards. And certainly if you misutilize them and go on expensive trips and buy clothes and stuff that you don't need, and you jack up those credit cards and you have a tough time paying them back, yeah, that's going to hurt your credit score. But actually having no available credit with revolving accounts will also lower your credit score. The next part of your credit score is based 15% on the length of time you've had credit. So if you never open any credit, if you pay cash for your cars, that's going to hurt your credit, right? So you want to have those established accounts, and especially, again, revolving accounts and credit cards. That's going to help build up your credit. This is also why older people tend to have higher credit scores. If you've had open accounts since 1970s, 1980s, and then you compare that with a 25-year-old that maybe only has 3 or 4 years of credit history, clearly the person with the longer time of established accounts is going to have a better credit score. Now here we go. 10% of your credit score consists of new credit, including those hard credit inquiries. So if someone tells you that your credit inquiries are going to just ruin your credit score, that's just not true for the most part, because it only makes up 10% of your credit score. So credit scores go from 350 to 850. It's about 500 points that your credit score is taking into account. So 10% of that would have to do with hard inquiries, and not even the full 10%, maybe 5, 6, 7, just depends. And then there are different credit inquiries, right? So if you get several credit inquiries because you're shopping around for the best mortgage, and they're all mortgage inquiries, then the FICO score will only count that as one inquiry, even though you went to 4 or 5 mortgage brokers and got 4 or 5 different mortgage quotes. Same thing with auto loans and student loans. So anytime you're shopping around for the best mortgage, auto, and student loan, those inquiries will all count as one, as long as they're done in a 45-day period of time. Now, if you go and apply for revolving credit, those are, usually single bureau pulls, so credit cards and business credit lines, revolving accounts. Those are usually just one credit bureau pull. They're not going to be a tri-merge like a mortgage. So again, even if you go to 4 or 5 or 6 different business, revolving, or credit card type lenders, it's not going to have a huge impact on your credit score, because they're usually only pulling 1 or even at most 2 bureaus. It's rare that they pull more than that. So again, the bottom line here is hard credit inquiries do have an effect on your credit. They will lower it a little bit, but not very much. And if you're trying to get unsecured revolving credit and so forth for your business, whatever it is you're trying to do, obviously that's not going to have a significant impact. And even if your score went down a few points, let's say it went down 15 or 20 points, well, unless you're applying for more revolving credit the next month, which you can't qualify for anyway because you already tried to get those credit lines, it's not going to have a big impact. And for the most part, within 2 or 3 months, your credit score will usually bounce back quite a bit, especially as you add some new accounts, because that brings us into the next part of how your credit score is made up, and that's a mixture of credit. So the credit bureaus want to see that you have, installment accounts like mortgages and student loans and car loans. And then they also want to see that you have a mixture of revolving credit, credit card accounts and lines of credit. And they want to see that good mixture of credit. If you're missing one of the major accounts, then again, that will lower your credit score. So all this adds up to 100%. That's your credit score. That's your credit reporting system. And so harder credit inquiries, again, less than 10% of your credit score, not going to have a huge impact. Now, it will have a greater impact if you have a very thin credit profile. Let's say you only have 2 accounts and you go and apply at 30 lenders. Yeah, that's going to have a real negative effect because you don't have a lot of credit. If you have substantial credit or just a decent, regular, average credit profile, then the credit inquiries just are not going to have that huge effect. So the next time you're applying for funding and the loan officer says, oh, don't go and apply anywhere, don't let anyone pull your credit, yeah, that's true to a certain extent, but not if you're getting a mortgage, not if you're getting a car loan, not if you're getting a student loan, and really overall not true no matter what you're applying at. Now that said, it's important to get pre-approved with the best financing options possible so that you don't waste your opportunity to get funding, because once you do get some inquiries, then lenders will assume that you got funding because you already got the credit inquiries. So that's something to take into account. But again, the overall methodology and what I want to teach today is the credit inquiries, they will affect your credit, but certainly not to the extent that people, and especially loan officers in the finance industry, want you to believe. So that's our funding tip for the day. This is a video you may want to review over and over again, since it really breaks down how the credit reporting works on the credit score, and most importantly breaks down that mythology and the misinformation about credit inquiries. They will not ruin your life, probably aren't going to ruin your credit. You just want to be responsible with them, but that's why we have credit inquiries, to get credit, right? So if you're looking for credit, you're going to take some credit inquiries, not going to ruin your life. Have a prosperous week, and we'll see you next time.